Hello and welcome. And the real estate space continues to be in focus. One of the big outperformers over the last month or so in trade. In fact, the Nifty Realty Index has been up around 20% odd over the last month or so. So it's done very well for itself. And, when you're just looking at one company in particular, Marathon NextGen's today. And why are we doing this is because while we've seen a decent correction on the stock price, nearly 30% down over the last 12-month peak. From the peak all the way now, it's the returns, the 12-month returns have largely been flat. So that's the one interesting part. The second piece is we want to understand how trends are playing out, especially in the Bombay market. And Marathon has a very large exposure to the Mumbai market. Is discretionary spend picking up? Are we looking inward with regard to discretionary spend picking up in India? Then Marathon could be that play. And the Mumbai micro market is obviously one which is of deep interest, at least within that western belt of India. And therefore, we'll get that perspective. But taking a bit of a step back, trying to understand what we need to know about Marathon before we speak to management is it was incorporated in 1978, has an MCAP currently of around 3,200 crore. It develops residential as well as commercial real estate in Mumbai, fairly diversified portfolio overall. And it's a Mumbai-based developer and part of Marathon Group. In terms of the offerings, residential, let's quickly, just list it down. You've got luxury, premium, mid-income, affordable, and large townships. So they're across the board in terms of their offerings on the residential front. Even on the commercial front, they've got grade A offices, smaller offices, retail spaces. So it's a mixed bag again of sorts. So it's well diversified, really. That's the underlying. You've got some developers focusing on affordable, some on premium, some. Here, you've got a very, very well diversified offering across the Mumbai micro market. In terms of revenue streams, well, very simple. You've got sale of constructed units, which they do, typically residential, and then you've got leasing of commercial property as well. In terms of geography, I did mention only the Mumbai micro market is what they deal with. In Mumbai metropolitan region. In terms of the business model, it buys land or partners with landowners. Thereafter, construction via in-house teams. Revenue is obviously based on completion, but this is important because what we'll see in the P&L will be based on completion method and not based on approvals or post-OC. And therefore, the revenue run rate may not be exactly chunky unless there is obviously some completion which happens in a chunky fashion, which has happened, but otherwise, some of the chunky nature which we do see in some of the other real estate developers doesn't play out here as much. You've got rent through leased commercial spaces, which also kind of cushions the revenue gyrations which you see on the P&L, which is a positive. Then, in terms of track record and how to look at Marathon NextGen from a historic standpoint, you've got around 31 lakh square feet, which they've already developed. Around 60% of that has been in the affordable space, 20% in the premium space, and the balance has been in the office space. Ongoing is around 17.5 lakh square feet, so a very large ongoing pipeline which they already have. Now, affordable as a component has come down in the ongoing versus the completed, and that is at 47%. Premium is at 42%, and that comes particularly from Monte South in Byculla, which is their premium project, which they're selling currently in Byculla. And then there's 10% commercial and 1% other. So that's really the split with regard to the ongoing. Then the upcoming, and 32 lakh square foot of upcoming projects, which also will come through. You've got affordable, which is 64%. So again, affordable goes up. Premium is just 12% there. So that's possibly a negative going forward unless they are able to add premium in the upcoming. And then you've got office space at 23% and others at 1% odd. So that's really the split. Office space goes up as a component. In terms of current projects, and this again becomes important because you want to understand how much in terms of projects need to get executed and how much in terms of revenue needs to be realized through some of the projects that they're doing. One, revenue from unsold area currently is around 860 crore. So that is the quantum of revenue coming in from unsold inventory alone. So that is something which is still to be expected. The quantum of unsold inventory is around 30 lakh square foot, which will likely come through. How do we split this? And this is from existing projects, of course.
Some of that inventory yet to be built as well, just to kind of clarify. But from existing projects, that's the revenue pipeline. In terms of the split, there you go. So that's the split in terms of the revenue from unsold inventory. 61 crore coming in from NextGen in Panvel. Monte South is 1292 crore. Now, you may start to question as to how is it 861 crore when 1300 crore alone is from Monte South. Mind you, there's a 40-60 split there in terms of revenue recognition. And therefore, we're looking at only the revenue which comes to Marathon, which is 860 crore. But that's the broad brush split that you can see on your screen. Bhandup accounts for around 174 crore odd. And then there's Millennium in Mulund, which accounts for approximately 110 crore. So that's really the split on the 861 crore, which is, again, attributable to Marathon alone. Then you've got the percentage of the 30 lakh square foot, which is the unsold. Unsold. What's the split there like? So 30 lakh square foot is unsold. Out of that, 20% comes from NextGen Panvel, 20% from Monte South, 55% from Bhandup. So a chunk of that revenue is likely to come from Bhandup, which has a lower average realization. That's the real point I'm trying to drive home. And then as a percentage of GDV as well, a chunk of the percentage of GDV comes from Monte South, which is 2,700 crore, and Neo Homes in Bhandup, which is nearly 3,000 crore. So that's where the tilt really lies. That's where the game really lies in terms of game-changing numbers, which will likely play out. Now, the other piece is that they have land assets, and there's a merger which is at play where some of the Marathon entities are getting merged into the listed company. And as part of that merger, you're seeing 4.2 odd crore square feet of developable area, which will likely come on stream. Of course, over a period of time, it can't come on stream immediately, but that's really the essence of the story. What has been merged is around 418 acres of land. You can see Panvel at 205, Dombivli at 83, and Bhandup at 130 acres in terms of the acre increase. And that amounts to around 418 acres, which comes through on Marathon NextGen's books. And then that's the split in terms of square feet. And this is crore square feet, by the way. So 1.25 crore square foot, it gets added in the Panvel land belt that they have now, post the merger. Dombivli will add another crore. And then you have Bhandup, which will add 1.75 crore. So that is how things will stack up. Also, they're looking at redevelopment actively. And we will speak with management regarding all of this in terms of execution. Let me quickly look at the financials and take you through it. In terms of financial metrics, you've got revenue, which has grown at 24%, but has flattened over the last couple of years, as you can see. In fact, it's fallen in FY25 in terms of top line. EBITDA, though, has continued to inch upwards. But again, in FY25, we've seen a bit of a shrink on the EBITDA number, which is at 33%. Margins have held up fairly well for themselves, despite the shrink both on revenue and EBITDA. So margins have done well, but net profit has surged. And that's one of the pieces which we'd want to understand slightly better as to how the numbers are playing out versus execution and how percentage of completion method is getting accounted for. The second piece is with regard to 9-month FY26 numbers. You've seen a 6% degrowth on the revenue number. EBITDA is down around 13%, but profitability has jumped 35% because of what's playing out on the numbers. In terms of the margin trajectory, it's held up fairly well for itself at between 25 to 30%. That's where the margins currently stand at. Of course, we had 1 year where it notched a 34% margin number. In terms of the other metric that we'll talk about in operational metrics is the realization per square foot and the area sold. We've got around 2.5 lakh square foot of area sold in FY26, 9-month FY26. Around 46,000 was sold in Q3. And a booking value of approximately 630 crore has been registered in 9-month FY26. Collections, though, have come in at 800 crore. These are numbers just for your reference. And then you have realization per square foot in the commercial side at around 42,000 rupees per square foot. And on the residential side at around 17,000 per square foot for the 9-month FY26 period. In terms of the balance sheet now, and we'll quickly stack up the balance sheet. There you go. You've got around 2,200 crore of book value sitting in the balance sheet on a 3,200 crore base. 900 crore has been a QIP which they've done recently, which is reflecting in the 6-month figure FY26, which you can see on your screen. So 900 crore of QIP at 550 rupees a piece. So it trades at a 10% discount even to that. In terms of the debt, and this is where the picture changes drastically, they've become net debt zero and there's cash on the balance sheet, on the books. So again, it looks like a very strong balance sheet from a growth perspective. We'll try and understand, and they've made it very clear, no leverage on the balance sheet going forward as well. But what does this do? How much of cash do they have? How much are they going to deploy for development over a period of time is what we'll try to understand from management. In terms of cash flow, well, cash flow is not a metric that you typically track in real estate companies, but you have a net cash flow positive, and H1 FY26 will be sharply positive because there's been a fundraise as well. No concerns on the cash flow per se, but it's been chunky, and that's something that you'll want to continue to observe. No concerns, largely because there's no debt and therefore no refinancing of debt required per se. And you've also got an equity which has been raised and that should be sitting in the balance sheet as well. And therefore, in terms of cash flow, no concerns. Return ratios, well, they've been choppy in that sense, and that's why we've given this a neutral. They've fallen from 16 and 17%, 12% in FY25. So we've seen a bit of a shrink with regard to return ratios. We'll continue to monitor that, given the fact that they've done a large fundraise recently, and therefore return ratios may well be under pressure for some period of time. Let's talk about shareholding, and currently post the fundraise as well, the shareholding remains quite robust. 56% owned by promoters. There's been very strong domestic interest, 15% by domestic institutional investors, 5% by FIs, and 24% by the public. In fact, valuations, that's not the metric I've actually sent across to the team, but nonetheless, it trades at 15 times earnings. That is something that you want to keep your eye out on. With expanding profitability, of course, can that profitability sustain is the question. But if it does, it's trading at a discount to a lot of its peers, which generally trade between 25 to 30 times, most of them. And therefore, this one, that's the other reason why this one looks interesting. In fact, let me bring on board Mayur Shah of Marathon NextGen, joining us, and of course, from the promoter family himself, joining us to give us a perspective of everything that's playing out in terms of the business and the numbers. So how is business holding up? How is the Mumbai market doing in terms of realizations? How is traction building up in terms of sales? You have a fairly diversified portfolio. You have a portfolio in Byculla, Parel. You also have a portfolio in Dombivli as well, in the suburbs, Panvel as well. Give us a sense how things are playing out.
Good afternoon. So I'll just give you first the company thing where, like, in last 9 months, we have almost 200 crores of EBITDA and with 41% margin. And the PAT, ever highest ever, 166 crore has been announced by the company. So the company is, growth path. There is no question on it. And our portfolio, as you rightly pointed out, like we are, spread across Mumbai MMR region. Like we have almost 5 micro markets, which we are very strongly developing. One is Panvel, another is South Central is Byculla, Lower Parel, and Bhandup in Mumbai, and Mulund, of course, and Dombivli is this area where we have projects which are going on. And if you look at Mumbai MMR scenario, it's very strong, like 33% of 2025 total sold residential units, and totaling to 1.5 lakh units, which are, sold in Mumbai MMR. So Mumbai MMR story is very strong. If you look at new launches also across India, Mumbai MMR, scores in that also. And inventory overhang is only like 24 months. So this is a very good scenario for Mumbai MMR. And, I think affordable luxury, even, micro markets of central Mumbai, Byculla, Bhandup, Mulund, all these micro markets are doing very well on absorption front. So we see a very strong residential market, which is in Mumbai MMR. If I have to talk about commercial.
Yes. Please go ahead.
So if I talk about commercial, again, commercial also, Mumbai MMR has absorbed almost 12 million square feet of a commercial office space. And today, if you look at, occupancy level is almost 93%. And that is the reason you've been seeing a very high price real appreciation across all the commercial micro markets, including BKC, Lower Parel area. And recent transaction was a very record thing in BKC, almost 750 rupees a square feet rental, which is never heard. So, commercial is also doing very well in Mumbai MMR, in all the CBDs and SBDs.
So let me take a cue from that. With regard to Lower Parel and Futurex, how do you expect realizations to evolve? You expected realizations to inch upwards by around 10%. Are you more bullish? Would you hike that guidance?
Yes, definitely. I think if I look at last 1 year's data also, and the kind of transactions which are happening, at least 10% upside is available in the commercial market. And most of the Marathon Futurex inventory is almost ready and ready to occupiable. And the demand normally are strong in the ready units.
And what's the timeline of Futurex getting ready and going on stream?
So Futurex right now, whatever inventory which we have is almost ready, and people can come and immediately do the fit out. So it's with occupancy certificate, the entire inventory which we have now.
And how much of it is occupied? What's the kind of interest you've seen already, and what's the pace at which you expect near 93-95% occupancy, which is what you were describing?
So I was describing 93% overall Mumbai MMR, I'm telling you. So, that is something very high number. Most of the time, the vacancy is always 15 to 20%. Today, the Mumbai commercial market is so much absorbed, and there is new supply is coming very slowly. And that is the reason you will see such a high level of an occupancy rate of almost 93%. So, yeah, we really feel that in next 1 year, all our inventory will be absorbed.
Okay, I'll talk about NextGen, because that was the other piece I wanted to understand. By end of FY26, you are expected to get completion certificates on 2 towers of NextGen. Has that come through? And do the balance 2 towers also get completed H1 FY27 in terms of timeline?
Yeah, I think we already received occupancy certificate of 2 towers, and the 2 other towers are almost ready, and we'll be applying for occupancy certificates, and likely to get in, I think, next couple of quarters.
Okay. Give us the take, sir. You're currently at around 500 to 600 crore in terms of top line. You did FY25, FY24 was slightly better in terms of top line. Top line has come off. Does it rebound in FY27? And FY26 as well has been slightly softer. Does it rebound in FY27? And what will cause that to happen?
Yeah, so these are all real estate is very difficult to do in a quarter on quarter or year manner, because the project cycles are literally almost 3 to 4 years. So, depending upon that completion, near completion, is something which we are seeing traction to be very high in the luxury element, particularly where RTMI, like ready to move in, is definitely, sells much faster. While affordable, you have under construction sales, which is happening. So we have a mix of, basket of residential, affordable, luxury, commercial. That's the reason you are seeing that. But, overall, the company is on quite a good growth path. And we also added new projects during the last 2 quarters. So close to almost one acquisition of 840 crore. We have acquired one ongoing projects because our strategy is to, get the projects quickly on an execution mode. And we've been able to strike a deal on 3 ongoing projects of another developer where we have really invested, and we're going to see our revenue chip in very quickly from those projects, because they 35% of the projects are almost ready to be launched. This is totally 6 lakh square feet in Kanjurmarg, which we had acquired. So, the companies also from the QIP funds on constantly looking at asset light model, JD, JVA. And in Bhandup, in only 3 days, we sold 100 units. So, Marathon brand, we would like to, leverage strongly, which is doing excellently in every micro market where we are present. So, little bit more penetration with the projects which are available even from other developers, we are very happy to take up.
Right. Give us a perspective, sir. So you gave a perspective on revenue, but your bottom line has been growing has been consistently growing. What's causing that? My understanding is the higher other income number is flowing through to bottom line. What sits in that other income? Can you give us a sense? Is it investments which are yielding returns, or how should one look at other income?
Yeah, so other income is basically from some loans which were given to the group entity is yielding interest. However, now that we have merged all those group entity into the Marathon NextGen, and our NACBSE has already given an approval to this proposed merger, which is going to bring huge land bank into the Marathon NextGen. Approximately 418 acres will be merged through this merger. And we hope that within 6 months or so, we're now applying into NCLT, and typically it takes 6 to 9 months in NCLT. So the group, balance it, and the asset, all these assets will be coming into the Marathon NextGen entity.
Excellent. My next question was timelines, but you've covered that. So therefore, the other income number will start reflecting on revenue. Is that how it will play out, starting FY27 or FY28 or effective date of merger?
Yeah, see, one other thing which you are seeing that revenue being shown little less is also because we are having a JV project, and particularly Monte South, the revenue is not reflected because we have the minority partner 40%. And that's the reason, one of the things which we were saying, that how the net profit is, more, PAT is more compared to the revenue, because that revenue is not getting reflected in our books. That is one thing. And yes, from the projects which we have already started in this last 2 quarters, like Nirvana is another very big launch at Marathon Next Zone Phase 3, which is a 600 crore project top line and around 6 lakh square feet, which is also been initiated, and the bookings have already started in that project. So revenue from that project and the Bhandup new launches, which we have already done during the last 2 quarters, approximately 370 crore of projects which are launched. So, all these things, plus our ongoing projects top line, we will see definitely growth in the top line.
Right. So point taken. Last couple of questions. One is with regard to the cash balance you sit on. You sit on nearly 700 crore of cash, if I've understood it right, which is investments plus cash, amounts to approximately 680 crore at end of H1 FY26. What do you do with this money? One. Two, there was one piece of strategy, which was that you'll go into redevelopment related projects as well. That's not really played out in terms of announcements. How active are you in that market, and how quickly do you deploy this cash sitting in your balance sheet?
Yeah, we are very, very aggressively looking at JD, JV model. We are also looking at cluster redevelopment model. We are also looking at society redevelopment model. But we are very, very selective. We would like to have, cluster or something in central Mumbai side with this policy. And redevelopment, we would like to have particularly South Bombay or, green locations of Andheri, Warsaw. And we are quite progress in those projects where, it typically takes very long time, where the redevelopment process of identifying developer and signing development agreement. But I think you will be hearing very soon in next 2 quarters. So, all these investable fund, we would like to, bring on table at least another 3 to 4,000 crores of GDP to be added during the next 12 to 18 months.
So I have only 15 seconds left. So you've got 4.2 crore square feet of available development potential. Do you accelerate that given the cash on your balance sheet? And if so, how quickly?
Yeah, so the thing is, we have, we are going through this NCLT merger and all. And the moment we get the, everything sorted out, definitely we go very fast on launching projects, even on those land banks. Those land banks are very, very strategically located. Panvel, as you know, Panvel 3.0 is booming. It's going to be a next 10 to 20 years. You will see a very big boom in the Panvel market. Dombivli also, which we have land, which is having a bullet train station, and there is a announcement of a second BKC. After BKC, second stop is very close to our land bank. And similarly, Bhandup is a very exciting market, which has got 2 metro railways are coming through. And one very big thing is that Mulund to Goregaon, the tunnel work is also going to start, and in 3 years or so, this location will be very, very closely reachable to airport, BKC, western suburbs. All these markets are where the land banks are situated are going to be the biggest growth driver for next 2 decades.
Thank you so much, Mayur, for coming in and speaking to us. Completely timed out on this edition of All About Your Company. Thank you, viewers, for tuning in. Stay with us on ET Now. More action to follow.